Investors, hello. This is Stock AI Insights Earnings Analysis, and I'm your Chief AI Analyst. Today, we're diving into XPeng's third quarter 2025 earnings, which dropped on November 17th. And let me tell you, the headline from the CEO, Mr. He Xiaopeng, was pretty bold. He called it another set of record results. So let's dig in.
But first, the usual quick reminder, this content is for educational reference only and is not investment advice. As you know, all investing involves risk.
All right, here's what we've got on tap. We'll start with the record-breaking quarter that really set the tone. Then we'll get into that revenue surge and a huge profitability milestone. After that, things get really futuristic. We're going to explore their physical AI vision. Then we'll check out their guidance and finally wrap it all up with the final verdict.
So, let's start with the big picture. XPeng's third quarter, well, it was a massive inflection point. Seriously. The company didn't just break a record here or there. They set new highs across almost every important metric. It felt like a huge turning point for them.
And the CEO's quote really says it all. This isn't just corporate speak, it's the simple truth of a killer quarter. The main engine behind this? A massive surge in deliveries. We're talking a 149% jump year over year to over 116,000 vehicles. That's the kind of number that lays the foundation for everything else we're about to see.
Okay, so a ton of cars delivered. But how did that translate to the top line, to the actual money coming in? Well, the revenue story here is really interesting because it's not just about selling more cars. It's like they fired up a whole second engine for growth.
And here's the headline number. Get this, 20.38 billion RMB in total revenue for the quarter. In the hyper-competitive EV world we're in, a number like that isn't just good. It's a massive statement about their scale and market presence.
Now, look at this chart because it really tells the story. You can see revenue more than doubled, up 101.8% from this time last year. And it even grew a solid 11.5% from the last quarter. That kind of steep upward curve, that's exactly the kind of momentum you want to see.
So, where did all that cash come from? Well, obviously, higher vehicle deliveries were the main thing. But remember that second engine I mentioned? Here it is. Revenue from what they call services and other shot up 78%. And the big driver there? Money they're making from providing R&D services to the Volkswagen Group. This is huge. It's a high-margin business that basically proves their tech is world-class.
All right, growing your revenue like a rocket is awesome, but we all know the real challenge in the EV game, right? It's actually making a profit. And in Q3, XPeng hit a major milestone on that front.
For the very first time, their gross margin broke through that magic 20% barrier, hitting 20.1%. You know, this is such a critical number. It tells you how efficient they're becoming and that they have real pricing power.
And look at this chart. You can see just how big of a jump that is from 15.3% last year. So how did they do it? Well, management says it's two things. One, they're getting smarter about costs in their factories. And two, it's that high-margin revenue from tech partners, just like that VW deal. It's all connected.
And believe me, they are not stopping there. The CEO came out and set a really bold, really clear goal to get the whole company to break even in the very next quarter. That's a massive signal that they're shifting from that growth at all costs mentality to focusing on real, sustainable financial health.
Okay, now this is where the story takes a turn into the future. Because as impressive as all these Q3 numbers are, XPeng is basically screaming from the rooftops that they're playing a much bigger game. They don't want you to think of them as just another car company.
They have a name for it, physical AI. So what does that even mean? Simply put, they want to use everything they've learned from building smart cars to build all kinds of intelligent machines that can physically interact with the real world. We're talking way beyond cars. Think a whole ecosystem of smart robots.
I love this way of thinking about it. The car isn't the final product, it's the launch pad. It's like all that incredible tech they've developed for their EVs, the self-driving AI, the batteries, the software, that's just the first stage of the rocket. The real destination is a much bigger world of robotics.
And trust me, this is not some vague dream. Look at this roadmap. It is incredibly aggressive. In 2026 alone, they're talking new EVs, 3 different robotaxi models, and starting mass production of humanoid robots. And then, to target selling over 1 million humanoid robots a year by 2030? Wow. The scale of that ambition is just staggering.
And just in case you didn't grasp how huge this bet is, listen to this prediction from the CEO.
He flat out said he believes the market for humanoid robots will one day be bigger than the entire car market. That's the vision. That's why they are pouring so much money into R&D.
Okay, so we have a fantastic quarter in the rearview mirror and a wild, futuristic vision ahead. But what about right now? Let's break down their official forecast and, interestingly, how the market reacted to all this.
So their official guidance for Q4 looks pretty strong. They're forecasting deliveries between 125,000 and 132,000 vehicles. That's growth of up to 44% year over year. And on the revenue side, they're expecting a really healthy jump too, up to about 43%.
But, and this is where it gets a little strange, here's the paradox. Even with that confident forecast, the stock actually dropped after they announced all this. So what happened? It seems like the market was zeroed in on the fact that Q3 revenue barely missed some of the highest analyst guesses, and that the Q4 guidance, while strong, maybe wasn't quite as explosive as some people were hoping. It's that classic Wall Street story, right? Great just wasn't good enough.
Okay, so let's try to wrap all this up. What's the final verdict here? How do you balance these fantastic current results with what looks like a really ambitious, and let's be honest, really expensive future?
On one hand, you have a company that is absolutely crushing it in their core business. I mean, they're building and selling cars better and more profitably than ever before. But at the exact same time, this pivot to being a physical AI company, that's a huge, long-term, and very capital-intensive bet on a future full of robots.
And that brings us to the final verdict. XPeng's Q3 shows strong operational execution, while its pivot to a physical AI company signals a capital-intensive strategy focused on a robotic future. The real challenge will be balancing the profitable present with that very expensive robotic future. What do you think about this balancing act? Share your thoughts in the comments. See you next episode.